Hello and welcome back to the American Dream Portfolio. In our last video, we asked 3 important questions about asset appreciation. What causes an asset's price to go up? How much appreciation do we need to get American Dream results? And are creative destructors the only assets we should invest in, or are there other options that will get us superior performance? Let's tackle these questions in order. First, what causes an asset's price to go up? Well, in our video about creative destruction, we saw a strong connection between life-altering businesses like Amazon and powerful stock price appreciation over 2 or 3 decades. Why this connection? Because the most reliable cause of long-term appreciation of stock prices is investor expectation that earnings, also called profits, will increase over time. Recall that investors in stocks are part owners of the company and, as such, own their representative piece of the profit pie. If they anticipate that the profit pie is growing, they are likely to bid up prices in line with their expectations. As creative destructors achieve dominance, their profits typically increase substantially above the rate of inflation, so there will be no shortage of investors who want a piece of that action. As for those companies that are not creative destructors, we will address that question later in this series. Of course, the stocks of profitable companies are not the only assets that appreciate. What about stocks of companies with no profits? Or with losses? The best answer here is that investors may bid up the price of any stock if they believe that company has a promising future. A most unfortunate example of this was the dot-com bubble of the late 1990s. At that time, investors had unjustifiable faith in the ultimate success of any company with .com in its name. It made no difference that many of these companies had no profits and were bleeding cash. The mantra was, "This time it's different," meaning that a great .com business did not require profits to be successful. Recall that even superior companies like Amazon, then called Amazon.com to take advantage of the mania, nearly got destroyed in the crash that followed. But ultimately, Amazon and other well-run companies prevailed. As we consider other asset classes, cash, bonds, commodities, and real estate, we find that all can appreciate except cash. Cash can't appreciate because it is the ultimate medium of exchange, the ultimate measure of economic value. When we say an asset appreciates, we mean with respect to the dollar or other currency. The dollar can't appreciate with respect to itself, though it can appreciate with respect to other currencies, and a cash account can grow through the power of compounding. What about bonds? Why might they appreciate? The most common reason is that bonds go up in value when interest rates go down. Why is this? Well, imagine that you purchased a bond 2 years ago that will pay you 3% interest for 10 years. Now, 2 years later, you determine that interest rates have gone down such that the issuer of your bond, the US Treasury perhaps, is only paying 2% interest on newly issued bonds. This makes your 3% bond look pretty good. In fact, your 3% rate is 50% higher than the 2% rate new purchasers can get. That's a big jump. So if you choose to sell your bond now, rather than wait for it to mature at the 10-year point, you will receive a premium of perhaps 20% or so above the price you paid for it. At that higher price, the purchaser of your bond is still getting a deal comparable to what they would receive if they had purchased the 2% bond instead. Of course, interest rates can also go up, but we'll discuss that in a future video. A bond may also appreciate due to the simple economic driver that impacts all investment prices: supply and demand. In times of economic or geopolitical fear and uncertainty, investors may exhibit what is sometimes called a flight to safety. In this scenario, investors are not so much concerned with making a profit as they are with preserving what they already have. One of the safest investments is generally believed to be bonds issued by the US government. Hence, these bonds may be bid up in price during uncertain times, regardless of interest rate movements. How about real estate? Real estate, like bonds, is sensitive to interest rate fluctuations. When rates go down, mortgage rates tend to go down, making real estate more affordable, with a resultant increase in demand and in price. And you've heard about the importance of location, location, location with respect to real estate. This suggests that real estate will tend to go up in price in desirable locations, such as popular vacation spots and economically and culturally vibrant areas. Unless the economy is experiencing very hard times, these locations will typically see demand outpacing supply, with an accompanying increase in prices. What about commodities? On this channel, we are mainly concerned with gold, so why does gold appreciate over time? Over the centuries, gold has been both a medium of exchange and a store of value. It has many physical properties that allow it to perform those functions well. As governments have moved to fiat currencies, which is money backed only by government promise, we have seen the supply of fiat money increase much faster than the supply of gold. With greater amounts of fiat money in circulation relative to gold, gold will appreciate relative to the fiat money. There are other factors that affect the supply-demand dynamics of gold. Its price may rise with fears of inflation or social or political unrest. In this capacity, gold, at times, has been seen as a safe haven asset, although this belief is not always justified. For example, while gold appreciated impressively during the 1970s inflation era, it did not perform as well during both the financial crisis of 2008 to 2009 and the COVID pandemic of 2020, when gold prices tumbled along with stocks, although not with the same severity or duration. And so, to the question, what causes the price of an asset to go up? We find many answers. Some appear to make sense, and some do not. But, fundamentally, the many reasons come down to supply and demand. Supply of these assets typically cannot be changed rapidly, but demand can turn on a dime and is often rooted in human emotion as much as it is in accepted economic reality. Next up, we tackle the question, just how much appreciation do we need to get American dream results? See you then.